Good morning, my dear students. Today, let us learn the methods of credit control of central bank. The various methods employed by the central bank to control credit creation are classified into two groups. They are quantitative or general methods and qualitative or selective methods. So, under the methods of credit control, that is first one is quantitative or general method. We are going to learn about first bank rate, second open market operations, third variable cash reserve ratio. And second, under qualitative or selective methods, we are going to learn about that is credit rationing, second direct action, third moral persuasion, fourth publicity, fifth regulation of consumers credit, and sixth regulating the marginal requirements on security loans. Controls are designed to regulate the volume of credit created by the banking system. Under this, very first we are going to know about that is bank rate policy. The bank rate is the rate at which the central bank of a country is prepared to rediscount the first class securities. It means the bank is prepared to advance loans on approved securities to its member banks. As the central bank is only the lender of the last resort, the bank rate is normally higher than the market rate. For example, if the central bank wants to control credit, it will raise the bank rate. As a result, the market rate and other lending rates in the money market will go up. Borrowing will be discouraged. The rising of bank rate will lead to contraction of credit. Similarly, a fall in bank rate will lower the lending rates in the money market, which in turn will stimulate commercial and industrial activity, for which more credit will be required from the banks. Thus, there will be expansion of the volume of bank credit. Now, let us discuss the second subpoint, that is open market operations. This method of credit control is used in two senses, in the narrow sense and in broad sense. In narrow sense, the central bank starts the purchase and sale of government securities in the money market. But in the broad sense, the central bank purchases and sale not only government securities but also of other proper and eligible securities like bills and securities of private concerns. When the banks and the private individuals purchase these securities, they have to make payments for these securities into the central bank. This gives result in the fall in the cash reserve of the commercial banks, which in turn reduces the ability of create credit. Through this way of working, the central bank is able to exercise a check on the expansion of credit. Further, if there is deflationary situation and the commercial banks are not creating as much credit as is desirable in the interest of the economy, then in such situation, the central bank will start purchasing securities in the open market from commercial banks and private individuals. With this activity, the cash will now move from the central bank to the commercial banks. With this increased cash reserves, the commercial banks will be in a position to create more credit, with the result that the volume of bank credit will expand in the economy. Now, let us know the third one, variable cash reserve ratio. Under this system, the central bank controls credit by changing the cash reserve ratio. For example, if the commercial banks has excessive cash reserves on the basis of which they are creating too much of credit, which is harmful for the larger interest of the economy, so it will raise the cash reserve ratio which the commercial banks are required to maintain with the central bank. This activity of the central bank will force the commercial banks to curtail the creation of credit in the economy. In this way, by raising the cash reserve ratio of the commercial banks, the central bank will be able to put an effective check on the inflationary expansion of credit in the economy. Similarly, when the central bank desires that the commercial bank should increase the volume of credit in order to bring about an economic revival in the country, the central bank will lower down the cash reserve ratio with a view to expand the cash reserves of the commercial banks. With this, the commercial banks will now be in a position to create more credit than what they were doing before. Thus, by varying the cash reserve ratio, the central bank can influence the creation of credit. Here, the question arises which is superior, either variable cash reserve ratio or open market operations. From the analysis and discussions made above these two methods of credit, it can be said that the variable cash reserve ratio method is superior to open market operations on the following grounds. That is, open market operation is time consuming procedure while cash reserve ratio produces immediate effect in the economy. Open market operations can work successfully only where securities market in a country are well organized and well developed. While cash reserve ratio does not require such type of security market for the successful implementation. Open market operations will be successful where marginal adjustments in cash reserves are required. But the variable cash reserve ratio method is more effective when the commercial banks happen to have excessive cash reserves with them. These two methods are not rival, but they are complementary to each other. Let us learn the second method, that is qualitative or selective method of credit control. The qualitative or the selective methods are directed towards the diversion of credit into particular uses or channels in the economy. Their objective is mainly to control and regulate the flow of credit into particular industries or business. Now let us know the important methods of credit control under selective methods. Very first, that is rationing of credit. Second, direct action. Third, moral persuasion. Fourth, method of publicity. Fifth, regulation of consumers' credit. Sixth, regulating the marginal requirements on security loans. Let us know one by one the selective method of credit control. Very first, rationing of credit. Under this method, the credit is rationed by limiting the amount available to each applicant. The central bank puts restrictions on demands for accommodation made upon it during times of monetary stringency. In this, the central bank discourages the granting of loans to stock exchanges by refusing to rediscount the papers of the bank which has extended liberal loans to the speculators. This is an important method of credit control and this policy has been adopted by a number of countries like Russia and Germany. Next one is direct action. Under this method, if the commercial banks do not follow the policy of the central bank, then the central bank has the only recourse to direct action. This method can be used to enforce both quantitatively and qualitatively credit controls by the central banks. This method is not used in isolation. It is used as a supplement to other methods of credit control. Direct action may take the form either of a refusal on the part of the central bank to rediscount for banks whose credit policy is regarded as being inconsistent with the maintenance of sound credit conditions. Even then, the commercial banks do not fall in line. The central bank has the constitutional power to order for their closure. This method can be successful only when the central bank is powerful enough and has cordial relations with the commercial banks. Mostly, such circumstances are rare when the central bank is forced to resist to such measures. Now, the third is moral persuasion. This method is frequently adopted by the central bank to exercise control over the commercial banks. Under this method, central bank gives advice, request and persuasion to the commercial banks to cooperate with the central bank in implementing its credit policies. If the commercial banks do not follow or do not abide by the advice or request of the central bank, no gross action is taken against them. The central bank merely with its moral influence and pressures with the commercial banks to prevail upon them to accept and follow the policies. Fourth is method of publicity. In modern times, central bank, in order to make their policies successful, take the course of the medium of publicity. A policy can be effectively successful only when an effective public opinion is created in its favor. Its officials through newspapers, journals, conferences, and seminars present a correct picture of the economic condition of the country before the public and gives a prospective economic policies. In developed countries, commercial banks are automatically change their credit creation policy. But in developing countries, commercial banks being lured by regional gains. Even the Reserve Bank of India follows this policy. Fifth one is regulation of consumers' credit. Under this method, consumers are given credit in a little quantity and this period is fixed for 18 months. Consequently, credit creation expanded within the limit. This method was originally adopted by the USA as a protective and defensive measure. Thereafter, it has been used and adopted by various other countries. The last one is, that is sixth, changes in the marginal requirements on security loans. This system is mostly followed in USA. Under this system, the Board of Governors of the Federal Reserve System has been given the power to prescribe margin requirements for the purpose of preventing an excessive use of credit for stock exchange speculation. This system is specially intended to help the central bank in controlling the volume of credit used for speculation in securities under the Securities Exchange Act 1934. So my dear students, today we have learned the methods of credit control of central bank. Thank you.